This is the CRE Weekly Digest by Lightbox, a firm transforming the commercial real estate landscape by connecting every step of the CRE process with comprehensive tools and data. I'm Melissa Lewis with our experts Manus Clancy and Dianne Crocker. It's the week ending January 30th, and here are a few of the macro highlights we're tracking. Surprising no one, the Fed held rates steady at this week's meeting. Yen volatility is something to watch. Stocks hit new all-time highs. Amazon announced 16,000 layoffs. And on the soft data front, two things worth mentioning. Consumer confidence just hit a 12-year low point, but CREFC's new sentiment index points to a market that feels increasingly open for business. Manus, what's your take on the week's market news?
Well, we're recording this on Thursday, January 29th, around midday. And until this morning, the theme of what we've been talking about at Lightbox, we've been putting out blogs to this effect and so forth, is that the K-shaped economy that everybody's been talking about for so long got even K-er. Now, I'm going to need a better term for that going forward, but on the upper end of the K, there was a lot of good news for people that are well-to-do. We saw probably surging 401ks, surging portfolio values as the S&P hit several more new all-time highs. In fact, the S&P 500 topped 7,000 for the first time a couple days ago. And so on that part of the economy, I think people are feeling quite good. Is it rational? Is it stretched? Is it overly enthusiastic? I don't know. But I think for people who wake up every day and check their Vanguard or T. Rowe Price accounts, they're probably feeling pretty good. And then on the other side, as Alyssa mentioned, on those soft data points, it's a different story. We saw a conference board confidence number that remains in the doldrums, that it remains close to historic lows. We're at a 12-year low on that reading, which reflects probably several things. The job market is soft. Goods and services remain expensive. And now, over the last month or so, we have images coming out of Minneapolis which are unsettling. Now, what's happening in Minneapolis doesn't touch anybody's pocketbook, but it does give people the impression that perhaps the U.S. is on the wrong track, and that could undermine confidence. So it does feel like, in some ways, it was a very good week. Investors felt good about rising asset prices, but there's an awful lot of uncertainty on the other end. And you wonder how this resolves itself going forward.
Yeah, definitely, Manus. First of all, you are such an influencer that I want to go on record as saying that that term K-er could soon be sweeping the nation. It's a little awkward, but you never know. But I think your comments on that front brought to mind something that I heard yesterday. I was in Manhattan and I attended a presentation on the market outlook that was given by James Bonneker. James is an economist at Cushman Wakefield, and he works with Rebecca Rocky, who is a past podcast guest. And James mentioned the K-shaped economy. And the stat that he shared that stuck out in my mind was that the top 10% of wealthy consumers account for 50% of spending. You know, it's a remarkable stat, and I think it's an important one for people to remember. A very small portion of consumers are driving a significant share of overall spending, and they're behaving very differently from consumers who I think have sentiments that are reflected in the consumer sentiment index that you just talked about. You know, they're more worried, they're pulling back on spending. And I think that context it's important to remember, right? As we hear about things like the stock highs, when we read about how GDP growth is on the upswing. Yeah, GDP is still strong, but it's certainly not uniform. And I agree, you know, I think the low reading on the confidence index means that folks on Main Street, maybe they are getting a little more worried about higher prices at the grocery store and jobs and income and business conditions. And maybe the path that this country's on is kind of shaking confidence on Wall Street. But literally on the same day when that confidence index came out, the CREFC index that you just mentioned, Alyssa, came out with their fourth quarter index reading higher than it was a year ago. And Lisa Pendergast, who was also a guest on this podcast, noted that for the first time in quite some time, the capital market is really feeling increasingly open for business. So the mixed bag of soft data points is really still all over the board.
It certainly is. And I do think there's not a lot of, at least as far as I can tell, a lot of correlation data between when you see things like civil unrest, how that moves that confidence barometer very much. But I have to think it's very, very significant. I have to think that people think when you get on that wrong track, regardless of whether they're employed, that they feel like they have a stable job situation, that their wallet is full, that they're managing expenses, that it does put a lot of downward pressure on that particular number. But just to kind of reiterate what we've been saying really since the summer, right? It's impossible to call this a blip any longer because we're now 7 or 8 or 9 months since this began. For 9 months, the stock market has continued to see record highs over and over and over again. PE ratios are stretching to historic levels, yet it comes at a time where home builder confidence is cratered. Long-term interest rates remain naggingly high. Job creation has been anemic, and the threat of additional tariffs lingers in the background. So I've been saying since June that this seems like an untenable paradox, that somehow this has to end. And how does it end? I don't really know, but all we keep seeing is enthusiasm, as you mentioned, from lenders, property owners, banks on the CRE side, and stock market exuberance on the equity side. Now, this morning we saw a big sell-off. We are Thursday morning, January 29th. Microsoft came out last night with tepid earnings and even more disappointing forward-looking guidance. Its stock was down 10 to 12% this morning. Maybe that's the start of some kind of correction that we'll see. I guess time will tell. But it is a paradox. I don't have another word for it, between what we're seeing happen in the equity markets, what we're seeing bullishness-wise in the lending markets, and what's compared to what we're seeing in the home builder confidence measures and other pieces of data.
Yeah, I mean, it makes forecasting nearly impossible because things are all over the board. And back to the presentation that James Bonneker gave yesterday, he used that term, cautious optimism, which is on my list of the most overused words leaderboard, right up there with resilience. But in this case, the shoe fits. You know, he pointed to a lot of the things that you just mentioned and a lot of the things that we've been reading about, which is, you know, rate volatility is settling a little bit. The markets, I think, feeling pretty comfortable. I'm talking about specifically commercial real estate. You know, spreads are tight. He mentioned that markets are pricing risk at historically low levels, that institutional buyers are reappearing in force, that deal sizes are growing larger. New York City's market is leading the recovery, and that leaves the folks that he's talking to with a sense that this year is shaping up with the potential to be a better year than it was last year. But you just mentioned a laundry list of things that could derail that and certainly are worth watching.
One of the things that has been on heavy repeat for me, talking about terms that are overused or themes that we go back to over and over again, I have been a big believer for a long time that the hygiene in the lending market has been very strong, that we haven't been retracing the excesses of 2007 to date. And those excesses included incredibly high leverage for borrowers, incredibly tight spreads where risk was not being rewarded properly. If you remember back in the 2007 period, triple B minus bonds were trading at 75 basis points over treasuries, or even less, maybe even 65 basis points. There was no reward for taking risks. And we know that that ended very, very badly. And over the last 16, 17 years, I feel like lenders have really learned the lesson. We have been very disciplined. We haven't been overly pursuing risk returns. We haven't been pursuing yield. We haven't been juicing up LTVs. But something you just said, and you're not the first person to have said it, makes me a little bit concerned. And that is the skimpier and skimpier risk premiums that lenders are getting for what they're doing. And I think whereas B-piece lenders were once getting 400 basis points over the curve, whether it's fixed or floating, maybe even 500 basis points over the curve, now they're getting 225 or 250. And you wonder if we're starting to get a little bit too frothy in the lending markets, starting to chase yield, not getting rewarded in the way you should for the risk you're taking. I'd love your thoughts on that, Dianne.
I think you might be causing our listeners to pull out the proverbial erasers and redo their forecast for this year and make them a little bit more conservative. It's certainly a concern. I mean, we've been talking for a while about the fact that lenders are more disciplined. We saw the Q4 earnings come out first from the big banks and then another round that came out from the regional banks showing that things are largely positive and that it's basically all systems go for this year. But there's always a danger when things are rosy that they're a little too rosy and that it's not sustainable. I want to point out one thing that James said in his comments that I wanted to include here because it's not getting a lot of airtime, and that is there are provisions in the big, beautiful bill and tax cuts that passed in July that haven't really made their mark on the market yet and will work their way in. That fiscal policy is tilting in a more business-friendly direction, and that's something that could show up as a tailwind in terms of investment this year. Does it mean investment and lending will get too frothy? Does it mean that lenders will pull their horns in a little bit? I don't know. I think it's very, very hard to forecast in this environment where things will go once you layer on the geopolitical concerns that are really coming to a head now.
I guess the enthusiasm makes perfect sense, right? We've seen risk premiums really, really contract. So if you're a borrower, you're thinking, this is great. We are now 100 basis points, 150 basis points lower in cost than we were a year ago when you compare the contraction in treasury yields plus the contraction in spreads. Count me in now to put money to work because I could borrow a lot cheaper now. And if you're an originator, knowing that borrowers want your money, you're enthusiastic that you're going to hit your numbers. You're going to put money out there. The question, which may not be answered for 6 months or a year, is will there be lender's remorse at some point where risk was not rewarded at this time, that they were putting out money at spreads that was just a little bit too tight for the risk that they were taking. But before we go any further, I do want to take a quick detour. The one thing I'm keeping my eye on, which may not be something that people regularly watch, is the volatility in the yen, the relationship between the US dollar and the yen. There's been a lot of volatility in Japanese interest rates and the value of the yen. And historically, this has come out of left field to knock investors for a loop. So I'll try to go through this quickly. Some people may really understand it. Some may be tourists in this. But one of the most crowded trades for several decades has been the yen carry trade. And what that is investors borrowing yen at super low rates, using the proceeds to buy U.S. assets. The U.S. assets are usually higher interest-bearing assets and usually riskier assets, high-yield bonds, maybe CMBS bonds down the stack. What traders are doing, investors, speculators, they're arbitraging the interest rate between the U.S. and the Japanese rates. And this trade works as long as the rates stay wide between the two and that the currencies remain stable. What we've seen over the last week or two is a lot of volatility in rate and a lot of volatility in value of the yen. Enough so that Treasury Secretary Bessent has said the Japanese and the American leaders may have to take concerted efforts to support the yen. When people hear this, when they see this behavior, their first reaction is unwind the trade. Unwind the trade now so that I'm not stuck with something that I have to unravel at a loss. And so many people participate in this trade that when people start racing for the exits, a herd becomes a stampede for the exits. And when everybody's selling a high yield, when everybody is selling CMBS, it's unavoidable that risk premiums blow out. And the question is now, is this something that can undermine the confidence in the market? Something really to watch over the next couple weeks if this leads to a pullback. It did certainly during the great financial crisis. It did in the late 1990s. It did during the taper tantrum in 2014, and it did late in 2024 as well, and again in October of last year. So keep your eye on that. If you start seeing people talking about the unwinding of the yen trade, that may lead to the next stage being a sharp rise in risk premiums if past is prologue.
Look at that, Manus. Once again, you give a master class in a topic that sounds like it came right out of left field. I think yen volatility it's one of those risks that doesn't make headlines every day, but when it does, it really matters. I don't always worry about currency risk, but when I do, it's the yen. And to your point, it could get messy if you start layering currency volatility on top of everything else that we've been talking about here today. And I think looking back to 2025, if there's one thing that we learned, it's that complacency can jump to volatility pretty quickly. So you give us something to keep an eye on.
Yeah, if there's one thing I think can knock people out of their complacency, it would be something like that. If you started seeing US Treasury yields rising above where they are now, that 425 level, spreads starting to climb, active selling by money managers to get out of this trade, delevering and so forth, right? Sometimes these things just come out of left field, and it's possible that this is that trigger. Then again, maybe we stay complacent for another 6 months. It's very hard to know.
Dianne, let's pivot to the data dive. What do you have for us this week?
So this week we did something a little different and leaned in hard on the data that Manus's team pulls together in terms of where the deals are closing, what kinds of asset classes, and in what cities. And we peeled back the layer of the onion to look specifically at multifamily and which top 5 cities drove the strongest transaction volume. And this is specific to December. The 5 are Chicago, New York City, San Francisco, Oakland, Denver, and Seattle. So that means that of all the multifamily deals that closed across the U.S. last month, almost 1/4 were concentrated in those 5 cities. And Chicago and New York alone accounted for 15%. So the market right now is very differentiated, and multifamily market activity can vary greatly. But these 5 cities attracted the most interest, certainly at the end of the year.
I know we're going to get into the property type trades momentarily, but I do want to point out, one of the screens that I have up all the time is just a rolling log of what we're seeing in the multifamily segment. And it kind of tethers to what you were just saying, Dianne. I just brought it up just a moment ago. And if all you do is look for what apartment complexes have sold in the last 24 hours around the US, every single day, it's another 5, 10, 15 that just reside on that page. And I'm looking at that page right now as I have it open. One near Camden Yards in Baltimore, almost $50 million. Miami-Dade, a big sale there. In the Pacific Northwest, Widener Apartments gets a property ready for sale. In New Jersey, another big apartment sale. You look in Greensboro, another one, $61 million. This is all really from the last 12 hours. It just goes to show that when it comes to people deploying money, even though the multifamily segment has been at times laboring with low rent growth or negative rent growth, laboring to refinance loans, laboring with a bad debt stack, disappointment with the proceeds they get from refinancing, it's undeniable that we are seeing transaction activity that is really, really impressive in that part of the market.
Dianne, let's shift gears and head into our Did You Know for the week.
We have a market advisory council of environmental due diligence professionals. They're a really terrific group of 12 across the country. And I like reading what they say about the market because they're really at the front lines talking to investors and lenders, responding to demand for the environmental site assessments that happen before a loan or a deal. So today's Did You Know is from the latest quarterly survey of the councils. A solid 3/4 of the council expect to see growth in activity this year, and only one member expects a slowdown. So a lot of what's fueling that optimism are the same things that we just talked about. Stronger momentum for refi, pent-up demand for deals, more stable underwriting. I don't know, Manus, if they listen to today's episode, they might pull back those expectations a little, but they're not expecting a surge, but definitely steady, slightly higher momentum than last year. And I do want to thank the council members. They're busy people, and they respond to me pestering them every quarter to take the survey and to share their thoughts.
Manus, let's jump to the CRE stories making headlines this week, starting with office.
This week, there seemed to be a lot of headlines in California, some good and some bad. I think that the momentum in California has been decent. I think there's been a lot of headlines about growing momentum for AI leasing. We've seen some really big leases in downtown San Francisco. There's a growing sense of optimism that San Francisco may follow New York in terms of a recovery from the really disappointing last 3 or 4 years in terms of valuations. But it's a complex marketplace. It's all over the place in terms of valuations and momentums and so forth. So we'll run through these in no particular order, and people can derive their own conclusions. The first one comes from The Real Deal, a very positive story here. PSAI Realty Partners paid almost $200 million to buy a Mountain View business complex. This is that city's highest office deal in 5 years. The buyer there of the 5-building campus was Rockwood Capital. The complex itself, almost 300,000 square feet, leased to tenants like Databricks and Heartflow, although Databricks is said to be vacating. It's the first office sale in Mountain View to surpass $150 million in 36 months. So a very positive story out there. A second one, kind of a mixed bag, I would say. Divco West in talks to acquire a stake in 101 California Street for $775 a square foot. They would push the value of that property to $1 billion. Reporting there from Sarah Clearman of the San Francisco Business Times. And you might say, wow, after seeing values in San Francisco drop to under $400 a square foot and seeing this 10-figure price tag of $1 billion, you're thinking that's pretty good. But the downside of this is this property was valued at $1.5 billion in 2019. So a little bit of a mixed bag there. A recovery in value and the fact that Divco West wants to acquire a stake is a positive sign, but still 33% below where this asset was valued a couple of years ago. In San Francisco, in the Bay Area and Oakland, technically, Starwood forfeited Oakland office buildings to Deutsche Bank. In this case, Starwood had a $365 million loan that it's walking away from. They paid almost $500 million for the asset a couple of years ago. The three towers are at 1901 Harrison Street, 2100 Franklin, and 2101 Webster. So here you have the negative story.
I think you just covered the full spectrum of what's happening in office. Going back to the first one that you mentioned, the PSAI deal, what really struck me in the article I read about that was the fact that roughly 20 institutional groups were chasing that deal. And I think that fact is just as telling as the price, which you said was the priciest office deal in 5 years. Maybe the South Bay office market found its floor. Maybe this sends a signal, if you're an owner in that area, that the demand is there and that it could be competitive, assuming that you've got a property that is leased to stable tenants. And then the other thing that jumped out when you were talking was the Divco West deal on California Street. I feel like we've been talking so much about deals on that office block, and maybe we have to take a field trip out to California Street. But I think that what you covered is kind of a microcosm for what's happening in office. You have investors fighting over a piece of trophy space at one end, or they're looking at Class B office, and looking at a price that might be attractive, but allows them to spend money to make it more attractive and competitive, or to buy office that's really struggling and turn it into something else. I think the last story that you mentioned is particularly concerning because I think whenever an owner hands the keys back, it's a hard sign of reality. It's not just a commentary on the higher vacancy rates and falling values that we're seeing in some office assets, but, it's a vote of no confidence, I think, in the near-term recovery of that particular market, and a sign maybe that price discovery in the Oakland area still has a long way to run.
One other headline in that market, which really isn't limited to just that market, I think it's going to be touching a lot of markets. This comes from The Real Deal. The headline for this article: San Francisco faces a nearly $1 billion budget deficit over declining property values. As most people know, if you own a home, you pay property taxes. Sometimes an individual homeowner can challenge their tax assessment. They go into the tax assessor's office and they say, my house is not worth $800,000. It's worth $600,000. I want my taxes cut. Sometimes that works. Sometimes that doesn't work. But it happens all the time in the commercial real estate market that in San Francisco, in New York, in Chicago, in every major metropolitan area where values have gone from X to 0.5X, developers are going in and say, I am demanding a tax cut here. And what this headline is telling us, and this might be painfully obvious to everybody, but this has probably happened with 200 property owners in San Francisco. They've all walked into the assessor's office. They've all said, we want to cut. The data is undeniable. This thing isn't worth $600 million anymore. It's worth $200 million. Therefore, the assessed value goes down. Therefore, the tax bill goes down. And when that happens, you see stress on cities. And I think you're going to see this come to New York. I think you're going to see it in Chicago. And when that happens, tough choices have to be made. I think we're just in the early innings of this.
Yeah, I agree. This is really the downstream impact of the office value reset, right? It's finally hitting city budgets. And I agree, it's not just San Francisco. I've heard similar in Boston and DC and other central business districts across the country, because these assets that we talk about here that are trading at steep discounts are resulting in shrinking tax bases. And I think the reality is what you just said, that the price reset is a fiscal challenge that could take years to unwind.
Manus, what's standing out in the retail market this week?
Well, I guess you would say it's kind of what I outlined in the office space. There's some good and some bad. And the bad is Blackstone was reported to be selling a suburban Chicago retail property for a 60% discount. Blackstone bought the streets of Woodfield in the town of Schaumburg for almost $170 million in 2015. They recently sold that property to Utensky Capital Partners for $69 million, representing a 59% loss. Not the kind of story we've seen, and fortunately, not the kind of story we've been forced to report on all that often. Retail has been quite resilient, other than in the Class B and Class C mall space. This is kind of an outlier in terms of both the size of the loss and going against the tide when it comes to retail sales and retail valuations. A disappointing one there. But I did have a positive one here, and it kind of crosses retail and office together. This is from the Orange County Business Journal. I like this one quite a bit. Dwight Manley has paid $140 million for a 34-acre office park in Brea in Orange County in California. The buyer is going to turn this property into the first Costco in that region ever. In this particular case, the seller here is Heinz. They are selling the Beckman Coulter campus at 200 South Kramer Street for that $140 million number. The great news here is it's up from $115 million in 2018. So a nice 20% return for Heinz on this sale. And we're seeing an alternative use for an office that's probably becoming obsolete in that area.
The Schaumburg story that you mentioned was interesting because it's not often that you see such a huge discount on retail. unless it's an old mall. And this one wasn't. It was an open-air shopping center, but sounds like they really struggled when a big historic department store, Carson's, went dark and the math really changed. But it struck me that it could be an opportunity for the buyer to get a better tenant mix in there and maybe pay attention to the performance metrics that Greg Katz talked about before, like looking at the oil stains in the parking lot and going to see what visitors to that particular shopping center are gravitating toward and then modeling the tenant mix around that.
Okay, we have time for a few more stories. Manus, what are you seeing on the data center front?
Two stories caught my attention this week, both a little sobering for those that are expecting data centers to just pop up everywhere and meet the demand that the big seven, the MAGA seven tech stocks are looking to do. But the first one, Alicia Fabre of the Chicago Daily Herald, Lisle, Illinois, delays a data center hearing after an overflow crowd shows up in opposition to a 50 megawatt proposal for a data center there. A similar story from The Real Deal. Brennan Investment Group withdrew its proposed $2 billion data center campus in Barrington Hills after negative feedback from village officials and organized community opposition. That was the headline in the story. And this is no surprise. We know that data centers are going to be extraordinarily high users of energy. People are concerned that prices are going to surge in the areas where they live. And people are saying no to this. I don't think these are the last stories we're going to see like this. And again, I don't think it's a straight line between conception and development for a lot of those that think that they are going to pop up data centers in Illinois or Arizona or North Carolina, South Carolina, et cetera.
Right. There was a headline in the Wall Street Journal this week with projections on commercial real estate construction from FMI. And overall construction was expected to see little or no growth this year because of things like high rates, rising material costs, and so on. But data centers stood out as the lone exception, with the forecast for data center construction to rise 23% this year. But, you hear a story like this and realize, and it is, as you said, a stark reminder that as more proposals to build data centers move from concept to construction, you can't underestimate community pushback. I agree. I think it's going to play a bigger role in where data centers ultimately get built and where they don't, and the time that it's going to take to get them from the planning board to actual construction and breaking ground.
Before we close, let's turn to our slice of life. Dianne, you mentioned you came across a LinkedIn post from Richard Hill, Global Head of Real Estate Strategy and Research at Principal Asset Management. Richard will be joining us on the podcast in a few weeks. What caught your eye in his post?
Yes, Richard Hill is a great person to follow on LinkedIn because his posts are a balance of timely market intel with the occasional observation about parenting. I'm really excited to have him on the pod in a few weeks. But this week, after we all got walloped by a snowstorm here on the East Coast, Richard posted a picture of snow-covered stairs that he offered his daughter $15 to shovel. And he made a clever analogy between the snowy stairs and an underwater commercial real estate mortgage coming due in 2026, that there may still be a path out. Did you see that one, Manus?
He got a deal, it sounds like. $15 an hour in New York. You can't get anybody to roll out of bed for $15 an hour these days. So good on him for getting the shoveling done. But it does remind me of a time that on a night where I wanted my youngest son to go to bed early, I offered him a $200 iPad just to go to bed early. I said, here, you could have this thing in return for going to bed at 8:30, not 9:30. That was my story that was akin to the shoveling the snow for $15.
Did it work, Manus?
It did work. Can you imagine giving something like that where somebody values it enough to sell it to you for $250 that all you get out of it is somebody going to bed a half hour earlier, right? Talk about degradation of value.
Well, everything's worth what someone else is willing to pay for it. I think the trick to parenting is finding out what they value and using it to your advantage.
100%.
That's a wrap on this week's CRE Weekly Digest. Thank you to our production team at Brooding Media. Please join us every week as our Lightbox team shares CRE news and data in context. You can listen on any of your favorite podcast channels and send your comments or questions to podcast@lightboxre.com. Thank you for listening and have a great week.
Let's go.